please give a warm welcome to Vinnie Catalano as he will take over. There you are.
Okay, welcome everybody. This is terrific. What a great crowd tonight. Yeah, uncertainty. And that's kind of a big item to have us explore this evening. And with our panelists, I think we're going to really get a good examination of it. Let me just give you the outline of how this program works. It's broken out into 3 parts. The first part is I ask questions of our panelists. My questions tend to be a little bit more of a macro nature, so that this way we can kind of get a lay of the land, and then we turn to questions from all of you, which is really the important part of the program, and that's entirely up to you, whatever you wish to explore in the way of questions with our panelists. And then the final segment is the only segment that our panelists actually control, and that's a closing comment. We ask them to give us a thought, an idea, perhaps something we discussed this evening, something they're working on, to share with us as the final item, and then Phil will come up and close the evening. That's the format of the program. And one of the things to kind of remember and think about, and I remember Byron Wien, the famous investment strategist from years ago, when he was asked by the Wall Street Journal, why do we do these forecast events? What's the point of it? And he said, it's not so much the forecast, the prediction, it really is the process. If you understand the process, if you get into that whole way of thinking and exploring what the issues are, that's really the great value. You know, some of our panelists are going to get it real right, some are going to get it wrong as far as forecasting for the year ahead, but at least if you're taken into the process for yourself, and I think that that's the great value. And that's the great value for everybody here. That's why your questions are so important. There's also one other dynamic. My questions, like, as I mentioned, tend to fall in that category of the more macro, big picture. Your questions can be just about anywhere, and they tend to sometimes be a little bit more in the micro area. That is also a telling sign. One of the things that I look for in doing these kind of events is to hear what kind of questions everybody has. And year in and year out, and it's a great point that Phil brings up, is that there's uncertainty, and then you have a greater number of people. It'll be interesting to see the kind of questions that come out in this environment with a significant amount of uncertainty from a geopolitical perspective, and even from an economic perspective, despite the fact that the economy, U.S. economy, is doing well. There's a lot of issues that are out there. So what I'd like to do is ask our panelists if they would please come up and have a seat, please. Hey, Doug.
Long time, Vince.
Okay, and even though you have their bios and you have some handouts and all of that, a really good way to start this thing is to ask our panelists to take a moment to introduce themselves in their own words, tell us who they are, what their firm is, what they do, and then we'll explore some of the issues. So why don't we go with Sandy Koufax's cousin over there, start on the outside, and we'll work our way in. Doug?
I'm Doug Cass, relief pitcher for the Los Angeles Dodgers. I got the job because my cousin is Sandy Koufax, so I pull. I've been in the investment business for a long time. I started as a Nader rater. I wrote a book called Citibank with Ralph Nader, graduated with an MBA at Wharton, and I've been in the investment business for a long, long time.
For a little while,
and
yes.
I teach and I write.
Excellent.
A bunch of other things.
Great. Glenn?
I'm Glenn Reynolds. I'm one of the founders of a company called Credit Sites. We do primarily fixed income research, high yield emerging markets, and high grade. We're located in London, New York, and Singapore. I've been at it about 36 years, starting the show. But we could talk a little bit later about credit and some of the interesting things we're going to be seeing this year.
And Jeremy?
So Jeremy Schwartz, head of research at Wisdom Tree. I had my first internship in finance here at Prudential Securities, at the town center branch here in Boca. Went to Spanish River High and got to know somebody who was a broker there. Came back 99, 2000. But then I got my formal training at Wharton under Jeremy Siegel. Helped him with Stocks for Long Run. Came out the third edition in 2002. And then the Future for Investors came out in 2005. And then we joined WisdomTree when they were getting funding in 2004. And so I've been sort of the third longest employee there and helped create all of our research around our new indexes and thoughts on the markets.
Okay, excellent. Before we begin, do you want to hear a Sandy Koufax story real quick?
Yeah.
Okay, I'll give you a Sandy Koufax story real quick. 1965, a 17-year-old kid was in Los Angeles with his parents. And he was hanging out, and the parents were, they were two sets, his parents and another couple, that kind of thing. And the kid was bored, 17 years old. So the husband of the other couple said, hey, the Dodgers are playing tonight. Would you like to go to the game? And that kid said, sure. So he drove that kid, the 17-year-old kid, to Chavez Ravine. And as he's walking to the booth to buy a ticket for the mezzanine section, a woman comes up to this kid and says, well, would you like a free ticket? And being a good New Yorker, the kid said, where are the tickets? Where are the seats at, right? I said, oh, box seats, 11th row. Okay. So the kid goes in, sitting on 11th row, and who's pitching but his childhood hero, Sandy Koufax. September 9th, 1965. The night that Sandy Koufax...
Third no-hitter in a row.
What's that?
It was his third no-hitter in 3 years, and then a year later he pitched the perfect game.
No, that year he picked the perfect game.
Oh, that was the perfect game.
That was the perfect game.
Against the Chicago Cubs.
Chicago Cubs. But I'm going to give you one other piece of information that you might not know. Go ahead.
The pitcher was a guy that just came out of the minor leagues by the name of Henley.
Bob
right?
Hendley.
And Sandy struck out Harvey Keene.
Uh-huh. Sure.
And the announcer was Vin Scully. And it was actually the best. Am I interrupting you?
No, it's okay. I know.
It was actually the greatest. You go to YouTube and just listen to Vin Scully's.
There's no video of it, so yeah.
No, you listen to the radio. And he had some amazing pearls, which he did spontaneously. He was unbelievable. Sandy, like myself, was Jewish. One of the lines was, and Sandy Koufax is one out from the promised land. Another great line, he says, there's only 29,000 people in the ballpark,
right,
but there are 1 million butterflies.
That's right, yeah.
And then he said finally, with one strike left, it was 2-2 to Harvey Keene of the Cubs, and he said, the Dodger pitching mound is the loneliest place in the world.
Yeah.
One last anecdote, and you get to business.
Yeah.
So Sandy told me this great story that I'm going to share with you. It's really short. He was famous for not playing on a Saturday. It was a Jewish holiday, right. Yom Kippur, the Day of Atonement, the holiest day of the year in the Jewish religion. And he was actually in Wisconsin with his girlfriend's family at Temple, at Shul. And in his stead, the right-hander, Don Drysdale, who was a 20-game winner, was fantastic, pitched for him. He got mauled. In the third inning, it was 6-1. The Dodgers are losing. Walter Alston, the manager, gets out to take the ball from him to bring in Joe Perinoski, I think. Drysdale looks at him. He says, "Coach, I bet you wish I was Jewish today."
That's great. That's great. That's terrific. Well, anyway, just to finish on my story.
You think they would probably think we rehearsed this all?
Right. So at the end of the game, that was Koufax pitched his perfect game. But here's the other statistic: Bob Henley pitched a one-hitter. There were only 2 base runners in that game. So you tell me what the odds are of a kid from New York ending up in another city on a free ticket, seeing his childhood hero pitch a perfect game.
This is the greatest pitching duel in Major League Baseball history.
And at the time, and not at the time, for all time, the fewest number of base runners and the fewest number of hits in the history of baseball. That was me.
Who won? They won on an error.
What a surprise.
They won
right?
on an error. Who scored the run?
What's that?
They won on an error, and who scored it? It's
Lou
easy.
Johnson.
Shortstop.
Lou Johnson scored.
No.
Yeah.
Maury Wills.
No. All right, there we go. Lou Johnson. Lou Johnson scored.
Johnson was left fielder, right?
Johnson was, I think, third base. Anyway, okay. All right. Right. Okay, let's get to this here. All right, so talk about uncertainty, Doug. I mean, in 2 days, we're going to have a completely different situation in Washington. The markets were, for a while, rather enthusiastic about that idea. However, since the middle of December, things have gone flat. What's your take on where things are at in terms of the market? Because you get a lot of different comments, and talk about that within the context of the uncertainty factor of what might happen.
I'm gonna make it brief because I've been talking too much already. I hosted Bloomberg's Market Surveillance, which I do every couple of weeks last week, and Vinnie's actually on Bloomberg quite a lot. And I said to Tom Keene that Donald Trump will make volatility and uncertainty great again. When I was a youth and in business school, we learned that growth is stimulated by either monetary or fiscal policy, and monetary policy has lost its effectiveness at the zero bound around the world. We all agree with that, finally. And it's conjecture whether the timing and the magnitude of the fiscal stimulation administered by the President-elect Trump is going to be effective. I personally think it's going to be at best 2 or 3 years out, so there's going to be this hiatus period. So now I was watching CNBC this morning, and there's a new word, that there's new stimulation towards markets and economy. It's no longer monetary, it's no longer fiscal, it's animal spirits.
Yeah.
Now, I never learned about animal spirits, but I do know that there's a reason why they call it animal spirits rather than human spirits, because animals are dumber than humans. And so I think that we're in this extraordinary period of uncertainty at a point of time when valuations, whether measured, we were talking about Shiller's Cape ratio, or whether it's measured by the PE to GAAP or non-GAAP earnings. And by the way, the gap between non-GAAP and GAAP earnings has, I don't think, been as wide as it has been in 2 or 3 decades. So the quality of earnings is greatly reduced. Against GAAP earnings, the multiple's almost 27 times. Against non-GAAP earnings, it's more like 18, or more reasonable 18 times. So, I question, there's a great deal of uncertainty, and I think market participants are acting more like ostriches, and, dismissing the headwinds to catalyze domestic and global growth.
Mm-hmm. Now, I happen to agree with you, but I have to play the role of the opposite. And those that would think differently and might be more bullish, Doug, are the ones that would say earnings are about to ramp up, that they'll close that gap, that the spending programs, the fiscal stimulus that is due to occur is going to be constructive. And therefore, the overvalued market will close that gap. It will not remain as overvalued. Your thoughts?
I remember, I'm a real anti-consensus, outside of envelope type of guy. I remember that the S&P earnings consensus for 2015 was $136 a share, and it ended up closer to $110 a share. And estimates for 2017 aren't even back to that $136 per share. So the consensus, the strategists, talking heads, commentators, have all been wrong, both on global economic growth, domestic economic growth, and U.S. corporate profits. And I see no reason why they're not going to be wrong again. I think that I think the reflation trade is wrong. I think we're closer to Larry Summers' secular stagnation than many believe right now. And I think this earnings will be disappointing.
Okay, very good. Glenn, let's take a look at the handout that you provided for everyone. And there is a really terrific matrix. That's the one, CFA Society, South Florida. Okay, on page 3, this matrix. All right. Any items that you would like to bring to people's attention? One that sort of kind of stands out to me was the significant recovery in high yields performance in 2016 versus 14 and 15.
Yeah, this has definitely been one of the more unusual credit cycles in history, and that's a lot of what we've been spending our time trying to figure out, what these various Trump policies might mean. Instantaneously, the market got bulled up on the 8th because the idea is regulatory rollback. That means more capital being committed, more risk. But we're coming off a year in 2015 where you had the lowest relative return in basically high-yield history relative to a multi-asset class grid, and that's what 15 shows. In 16, we turn around, and this is the best late cycle year in high-yield history. So talk about a whipsaw. And on top of that, we still have all the same old recurring issues of income starvation, reach for yield, all the things people talk about regularly. That's still there. Except now people feel some fresh wind in their sails to keep this going for a couple more years. So regardless of whether or not the market is somewhat ahead of itself, for purposes of risk appetites, they're flying again. People are piling into leveraged loans. People are swinging out of duration exposure into maximizing credit risk again. That gives you a lot of legs for a lot of deals in a couple of years. That is, unless they wake up and they find out that the policies they built into that scenario are all wrong. And that's one of the things we're going to have to be worrying about. So right now, we went overnight, on November 9th into bullish credit risk and bearish duration risk for obvious reasons. And that's not a big mystery as to why. It's just how long can this last? And there's some huge tectonic variables that we need for infill, and we just don't have them yet. It's a remarkable policy-driven backdrop for risk appetites that I haven't seen before.
So how do you manage this with the? It sounds like there are significant tail risks from an economic point of view and the impacts on the financial markets.
Yeah, well, I think most people are identifying trade risk and policy execution risk, and that's that amorphous, touchy-feely, subjective variable that can blow your portfolio out of the water. It wasn't long ago where everyone forgot about duration risk, and we're just worried about credit risk. And now you're kind of flipping the page a bit. When in fact, both still very much lurk depending on the outcomes. So right now, it's very hard to navigate other than to get bulled up. And animal spirits are probably a good way to describe it. I'm just trying to figure out which of the animal chain we're doing right now in high yield, because in high yield, everyone's just buying, not worried about selling, and the inflows are coming. And that's usually when things go wrong. But there are a few things we know will happen. Taxes will get cut, and there will be some money being spent. What we don't know is some of these other big issues we'll probably talk about during the course of the evening around trade and border adjustments and tariffs and trade wars and a lot of things that can be very, very damaging to quite a few industry groups.
Okay, I'd like to come back to high yield in a little bit, but I'd like to ask you a question here in regards to the yield curve. It's on page 8 of your report. While we were sitting and having a little bite to eat before, you made mention of something to me about the slope of this yield curve and how it looks and problems in the past versus now. Your thoughts?
We spent a lot of time looking at yields in historical context and thinking through the total return potential and excess returns for credit asset classes. But the simplest snapshot is always, where was the yield curves in past cycles? You've always had a flat curve before you had the credit cycle crack. You've had flat curves, but not had the credit cycle crack, and that's the tricky part. But right now, as you can see here, we're only in the 4th high yield cycle since the mid '80s when high yield bonds and high risk credit and over leveraging really came into vogue. And right now, we're still a long way from flat, and it would take 3 or 4 tightenings to get there. And even then, if it's from a position of strength around fundamentals, again, that's going to be policy dependent. You have a chance in this cycle to have the longest credit cycle in history. The 90s was the longest one. But this is a very distinctive cycle because of the unique monetary cycle we've just gone through with. All the rules have kind of thrown out the window. But one thing we know we have, at least in terms of correlating, we haven't had a real crack in the credit cycle till that front end has come up high.
I have a question. Let's assume that the dire expectations for policy and the optimistic expectations for the President-elect's policies are both wrong, that some, kind of modest stimulation occurs. And let's say the Fed does move, as the markets expect, 3 times in this year. In your view, in a still kind of tepid 2.25% real growth environment, will those rate hikes produce, what will the influence be on the yield curve specifically? What will that induce lower, no change, or higher long-term yields, in your view?
The way you phrase it, we would see that as just creating a very modest bear flattener and plenty of demand for risk. High-risk credit assets will outperform, spreads will tighten, and the beat will go on, waiting to see where the deal cycle goes. Usually,
so the 2s10s, let's say, is at 130 bips now. Where would it go by the second tightening if we're in a 2.25% real growth environment?
you're still a long way from flat there, probably, because let's just assume, like in the last cycle, 2003 to 2006, the long end barely moved, and we just kept seeing the front end come up. So that type of bear flatness scenario is usually pretty bullish for risk and for credit assets, and you probably see a fair amount of deal flow. Where you start to see things get unruly is when you have upward shifts or steepening. And we have a hard time, the way you've laid out that scenario, that wouldn't be the scenario then. So you probably won't see the magnitude of outflows out of duration-sensitive funds, and you probably won't see the over excitement of too many inflows into high-risk assets.
So will 2.10s go back to 100 bips, 80 bips, 110 bips?
2.10s, well, I tend to look a lot at the 3 to 5, and that thing's been hovering around long-term average, around 125, 130-ish, on and off. That's the 5 years really the most relevant to a lot of the high-yield investors. 2.10s and 2.30 tends to be more the high-grade benchmark. But you're going to be in a very good shape in the debt markets, and I think that will stabilize really some of the outflows we've seen and some of the worries about the long end. So you're still a long way from being in a flat curve market, and that gives the credit cycle a long time to run, as far as I'm concerned. If you start to see the Fed over tightening because of hyperinflationary fears, not literally hyperinflation, but their fears being excessive, then you start to see the thing break, and that's when you start to see people worried on the long end, and that's when you might start to see an upward shift and a steepening. But we've had plenty of bear flatteners in the past without it killing risk. It's kind of it's a legend that rising front end rates kills risk. It doesn't. There has to be something else: bad deal quality, weak fundamentals, and that's not the kind of scenario you're painting right there. So it would be good for the credit markets, and then it comes down to some of these, there's a lot going to happen between now and mid-year around tax bills and so on.
Do you cover munis as well?
We have a muni analyst.
Do you think that you think there'll be some modification in taxation of municipals in the new administration?
It sure sounds like people are pricing that in as being pain in munis, and for a couple of reasons. I mean, also some of the muni benchmarks are long duration benchmarks, so that's been getting beaten up as the benchmark. So that one's been getting slaughtered also. But then there's talk about the retrenchment on the tax demand side. So you'll have demand weakness plus theoretical curve weakness. We've had it so far, but that isn't over yet on the inflation outlook. But today's numbers were tough, and if people start talking a lot about inflation, all bets are off on some of the redemptions in bond funds, including munis.
Okay. One of the things, Jeremy, that does not get spoken very much about is the very structure of the market. And ETFs were kind of on a spotlight for a while in regards to the very structure of the market and concerns about what ETFs might bleed back into, cause problems and things of that sort. We haven't heard anything in that area for quite some time. Are we at a really good period now with ETFs? Is it stable enough, strong enough that investors don't have to worry about there being some kind of a systemic risk that might be there?
I mean, ETFs at the basics are just a wrapper, and so a lot of people talk about the flows towards ETFs, and I whether it's flows to a bond like a bond fund, a mutual fund, separate accounts, hedge funds, money would go to whatever that asset category is. The ETF is just the wrapper, and it can't do anything to change underlying characteristics of the underlying. So equities, that are liquid, the ETF is very liquid. When you talk about flows to bonds or high yield parts of the market or bonds that don't trade as much, the ETF can't make that underlying more liquid. So it all depends on that category and whether it went to an ETF, went to a fund, a hedge fund, I don't think that, the question on the ETF isn't the right question. It's really that asset class that's the more important question.
Okay. Then one other item is to take a look at what's called a completion strategy, where an institutional investor wants to get the exposure in a particular area, has enough of the individual issues that he or she wants, and so, but can't find enough of them to get to that total percentage number that they want to get to, and then they complete it by using ETFs with that. You talk about some of the strategies in using ETFs that Wisdom Tree recommends to people as a portfolio strategy, because it strikes me that it's a very powerful tool to be able to use on a number of levels, depending upon whatever your investment parameters are, goals, et cetera.
Yeah, I mean, I think, and I want to try to come back towards even what Doug started with on valuations. I think that there's some tie-in there, especially to how Wisdom Tree constructs things. I mean, I think the way ETFs first started, it was just broad beta, the S&P 500, MSCI Emerging Markets, EFA, Russell 2000, and it was just basically, here's a way to get cheap, efficient exposure to the category, whatever that category is. And so that was ETFs, you'd say 1.0 from the first ETF, 93, the Spider, to iShares in the late 90s, and that was all there is. Starting about a little bit over 10 years ago, especially when Wisdom Tree started, you started seeing a rise of alternative forms of indexing, and I'd say what we do is really trying to solve valuation risk. So we do a lot of weighting around dividends, a lot of weighting around earnings, and so on this concept of how expensive is the market, a lot of the earnings on the market gets distorted by companies that are unprofitable. So if we start with a 2,000 company profitable universe, everybody has profits, you weight them by the total profit. So let's say there's $1 trillion in total profits in the US today. Once we remove the unprofitable companies, that total market US exposure today is around 16 times earnings. The small cap, where you look at the Russell 2000, the S&P 600, a lot of those indexes, depending on where you're pulling your PEs, 25, 30, 40, because a lot of those, the Russell 2000, 20% is unprofitable. So just stripping out the unprofitable companies, targeting only those with profits, you get 16 times earnings for small caps when you tilt towards that earnings stream. So I think a lot of where ETFs are going, they're trying to solve for more specific factors. You hear this smart beta factor investing, sort of other ways to introduce, whether it's a quality tilt, a value tilt. There's these low volatilities have been very popular recently. Now, you got to think about what are those underlying exposures you're getting to in some of these factors, like low volatility, high dividends, you get this big embedded interest rate factor. And so I think when you think about this reflation trades, or if interest rates are going to really start moving up, you have to worry about those parts of the market that are the most interest rate sensitive, whether it's high dividends or low volatility as a factor.
Okay. I have a question for everyone here. How many of you have seen, it's playing on Showtime, I believe, the docudrama called 0 Days? Okay, a few people. All right. 0 Days is about Olympic Games, the cyber attack that the United States and Israel launched on Iran back in 2007 and 8, and then it continued on after that. And I want to get to cybersecurity. Okay, that's where I'm going with this. Does Wisdom Tree have a cybersecurity type of play as of yet? And if not, when might it?
I mean, so far we've tried to construct very broad market exposures that we would think of as more, long-term oriented solutions. So we don't have any thematic, that specific sector strategies. There is a cybersecurity ETF. I'm not sure the exact ticker on that one. It's not something that we cover, but that is, you can get these baskets of as narrow as you want, or very broad-based strategies that you would think of as your core building blocks.
Okay, very good. All right, thank you with that. Glenn, I was mentioning before about wanted to come back to high yields, and going back a few years, high yield was a situation where default rates were not expected to be an issue for quite some time. We're coming closer to that point in which a lot of money is coming due, has to be rolled over, but it looks like the high yield field is still okay, and default rates are not anything significant, and that really, in many respects, is a heartbeat, a good canary in the coal mine in regards to the overall economy, would you say?
It's been a very distinctive high yield cycle, just on the virtue of the fact that we've had ZERP for so long. We've never had a high yield cycle where we didn't have a tightening until, this latest stage and only 25 basis points. So what's been going on is usually the self-fulfilling prophecy is refinancing and extension. You refinance and extend your liability structure, you live to fight another day. They call it kicking the can down the road in sovereign land, but in corporations, it's prudent and smart. It keeps you out of trouble because you never know when the market's going to gap on you. So the default cycle was actually up last year, not materially, but heavily concentrated in the number 1 and 2 industry groups, which was basically energy and commodities. And now it's going back down. It's going back down, and we expect to go back down fairly sharply. It's also a little bit distorted by these coercive distressed debt exchanges, where very often you get tagged with a default, but then that's really a one-off transaction. So high yield market's in remarkably good shape, considering they do have, there's a subset of the companies that are in trouble. They're weak credits, over-leveraged. There's dogs in every cycle. But there were less in this cycle because so many actually were able to execute on the back of monetary policy. It's a very distinctive cycle. I mean, these companies will meet their maker someday. But right now, we see defaults coming down. And with as many, and there's not as much maturity as you may think to clean up. A lot of them have already been pre-funded, cleaned up, and extended. And in fact, many of them have rolled bank lines where they have available facilities. So we're looking at a high yield market that's the highest quality high yield market we've had in my career since it started. That was when the market started. So that's just a function of good old-fashioned refinancing extension, and 50% of the market's double B. That's an average default rate of double Bs of 1% a year long term. So it's a strange market. There are plenty of dogs to find. The trick is to find them and avoid them. And a lot of people got overexposed energy. So where we had a little mini crisis, plus the overlay of the Volcker Rule, you didn't have the kind of risk bender you've had in the past, where people in the leveraged finance area would originate anything that hasn't been done over 3 hours back in the day. Now you had very tight regulatory controls, and you had a scare in the market that caused deal makers to pull back. So we got a long way to run still.
The problem is that, of course, that the tail risk is no longer in the private sector; it's now in the public sector.
You mean in terms of policy?
Sovereign debt.
Oh, we have,
and that's some serious problems, and perhaps in terms of order of magnitude, significantly more than we even had in the last cycle in the private sector.
We've never had a systemic backdrop like this in high yield. I mean, just Europe by itself is enough.
Right.
Let alone
unprecedented.
the black box of China.
I mean, the European banks, have never cured themselves. They never had the recapitalization that our domestic banks have. And as everyone knows, extension of credit by commercial banks in Europe are probably in the order of magnitude 6 or 7 times more important to the European EU economies than is the case in the United States.
Mm-hmm. Glenn, you mentioned Volcker Rule. Republicans want to get rid of it.
It's a balancing act. Right away, the immediate reaction was great for banks. They'll be able to take more risk, extend more credit, make more money. That is, unless, as I say, they don't, depending on how they operate in that kind of a framework. But how they're going to actually execute on a rollback of regulatory risk, it took through 2013 even to get some of the things in place from the 2010 legislation in the first place. So trying to roll back OCC rules that are in place on the ground around leveraged finance, trying to roll back all of these guidelines they've put in place around inventory controls and hedging practices. It's going to take quite a while, and they haven't even started yet.
Also, Glenn, a unique feature of this cycle is that what got Trump elected, the right of the Republican Party, has a populist theme to it, and are anti-big banks. So you basically have the leftist Senate Democrats and the right center Republicans disfavoring a change in policy towards letting them leverage up.
Yeah, both platforms had Glass-Steagall in
It's
it.
the only thing. Yeah, it's the only thing they agree with. And if you heard Bernie Sanders and Elizabeth Warren today, I don't think Volcker. This is a whole. Gets back to the. Like you said, there's kind of the Federal Reserve governors and Yellen said the same thing that you said. They haven't changed their economic forecast. They say, "Show me." And that's exactly what you just said. Show me. We can't change our forecast until we see, evidence. And if you think about it, it's hard to see regulation change materially in the next 12 to 24 months. And look at the other two factors. The core of that Trump ran on, the view that he's going to be able to accelerate the rate of growth of domestic activity is based upon repatriation and reducing the corporate tax rate. Well, the statutory corporate rate is now 35%, but the average S&P company has an effective tax rate of only 22%. So let's say they go down to 35 to 25%, it's not going to have a material impact. Second thing, in terms of repatriation, all the money is in 9 tech stocks, basically, that have the cash hoards. Chambers' replacement at Cisco said 2 weeks ago, he was asked on Bloomberg, if you have cash repatriation, what are you going to do with the $48 billion you have overseas? And he says 50% is going to go to buybacks, 40% is going to go to M&A activity, 10% will go in the dividend, and there's no discussion of CapEx. Mm-hmm. Ergo, no expansion in jobs. Ergo, no marginal increase in economic activity. So I think there's a lot of dreaming going on.
Sure. Well, to take that aspect of, in terms of creating jobs, information technology, communication technology, you hear a lot of talk, you see a lot of comments and articles written about the fact that automation has replaced, so many jobs and is now on the verge of really penetrating into the services area. I did a Bloomberg radio segment recently with Richard Baldwin, who wrote a book about the technology and the impact of technology. And he talked about in the services area, and he said, it is conceivable that you can have in a hotel a robot cleaning the rooms, and the person who is running that robot is somewhere else in the world working a heck of a lot less.
Right.
Then you have the medical robotics that are happening with that.
Well, think about it this way. U.S. industry is at 79% capacity utilization rate. So really, what is the incentive to expand? So you get the money here. You're going to use it in capital reallocation strategies.
Sure.
I don't know if anyone's watching the market. You saw Target guide down comps, fourth quarter comps dramatically. It's supposed to increase by 1%. They were down 3%. The channel shifts in retail distribution in and of itself are so anti-improvement in the labor market. Amazon may do $70 billion in sales, but the retail business is almost $5 trillion. So they have 1.5% market share. Can you imagine? I mean, they haven't even penetrated the market yet.
Right.
So we have these fundamental headwinds that disfavor reflation, economic growth, and favor secular stagnation. And I think there's a real leap of faith, as I said before.
Yeah, very, very challenging, absolutely. One area, Doug, that has always struck me as being very attractive is private equity. And it seems that private equity has certain inherent advantages over investing in publicly traded issues.
Yeah, you don't have to mark to market, so you don't have to really show your real performance for a while.
That's right, exactly. And you're in the room. You're in the room. You're like a Warren Buffett. You are in the room. You hear what's going on. You are an influencer of the outcome that's there. It looks like more and more money is going to gravitate to that part in that alternative investments category. Your thoughts on that?
Well, I think that generally we are, when you're at zero interest rates, you almost are by definition in a substandard return environment for risk assets, in my view, on a longer term basis, especially when valuations are elevated and we have the kind of global and domestic economic challenges that we face. Mm-hmm. So, I always thought private equity, there's a little bit of a Wizard of Oz feature to it,
Okay.
Jeremy's ETFs, you go to the prospectus, it's this full disclosure and transparency of the holdings of every ETF, not so much in private equity. I used to run an investment committee of a large endowment in a university. I was on the board of trustees of, and it was a lot of fun because for about 5 or 7 years you can't make a mistake.
Okay.
But the incremental, this gets back to, where the money is going in the markets. The market, institutional money is going to private equity.
Right.
Individual investors no longer talk about individual stocks. Ergo, the explosion in ETFs. And with hedge funds and other institutional investors no longer trading actively, the quant funds, the machines and algos have taken over as the dominant investors in the equity market. So you have this kind of different landscape, Vinnie, than we've seen in many, many years. And it gets scary because then you see flash crashes because not wisdom trees ETFs, but there are a large amount of ETFs, probably 30% of the ETFs that are basically have component holdings that are illiquid assets. And most market participants think their ETF is supposed to have greater liquidity and less, volatility than the underlying assets of the fund, which is not the case. No. And that's the danger in ETFs. So the next disaster will not be a wisdom tree, but it will be in a group of ETFs, and maybe look at municipal bond fund ETFs as a good example. Yeah, I don't know if you've ever traded or invested in individual off-the-rack municipal bond funds. Well, you can run a truck through the spread. So you can imagine a portfolio of 250 of those, and then, the ETF can act pretty wacky in periods of, kind of quasi-panic.
Mm-hmm. Jeremy, to Doug's point, bad apples.
I think there's a few things that I want to drill into there. One is on the trend towards indexing, and does it create opportunities for active managers? I think that's a concept that's sort of an interesting one. I think the trend, and is there too many ETFs, and what's that mean? I think one is what's really been shifting is you had the individual investor maybe 50 years ago, 80% was held by individuals, and they were speculating against. And the professionals could go against that uninformed individual. Now, the individual is removing themselves from the market and they're buying the baskets. And you could say the less informed people are taking themselves out and just saying, I'm going to buy the market. So the professionals are playing against a higher scaled level. So it's actually, I think, becoming increasingly harder to beat the markets because there's less, you could say, dumb money investing in the individual parts of the market.
And conversely, there's the super smartest money in the world in quant funds.
Yeah. But now, so the question is, what is this? Where is this, risk coming up in the ETF market? Or it's not. Again, I say it's not the ETF market. It's that the flows go to any asset class because the ETF is just a vehicle to get you broad-based exposure to any asset class. So if it wasn't coming into ETFs, it would be going into a mutual fund or a hedge fund. So it's really no different. It's money goes across asset classes. And the ETF is just that preferred vehicle for a number of them. Equities mostly. Fixed income, I could say, is still a drop in the bucket for ETFs. Still, the active managers, one of their last holdout is the fixed income market. And you could say people there have said, well, I don't want to give the most weight to the bonds that have the most debt. Why would I do that? So that's where they feel like active managers can add value. Although there's now more quant strategies coming into that market as well. But again, it's if there's just no interest in trading bonds, the ETF isn't going to change that. So that'd be no different if it was flows coming out of PIMCO. If PIMCO is selling and there's no buyers, the bond price would go down.
Mm-hmm. I'm going to ask two questions of Jeremy here, and then we want to turn to all of you for questions. So please think about your questions. Jeremy, beat the market. There are two approaches that ETFs have offered in this regard are managed ETFs and alternative investments ETFs. Thoughts on either of those? Managed ETFs sounds like almost like an oxymoron in some respects. Thoughts?
Yeah, the question is, when you think about wisdom trees indexes, what are we? Even the labeling is hard. The industry calls it smart beta. We used to go with the term passive alpha, where we're trying to create a set of rules trying to beat the market. So are we active or passive? It's all in the eyes of the beholder. We would say we're trying to create better risk-adjusted returns. So it really is an active goal, trying to beat the market and do it with lower volatility profiles. And so that's a managed ETF, but it's still done as an index strategy and still technically passive. So it's all semantics at the end of the day. You're going to see, at one hand, Vanguard zero-fee beta. You're going to have your active managers on the other hand saying, I'm going to really try to add value. And then you have this middle ground that's going to be rules-based, systematic, you could say quant strategies that are trying to provide better returns through an index. We are, spanning beyond equities. We have launched long-short strategies where we have factor strategies running the long portfolio and then doing systematic shorts of the market through different algorithms. So you're seeing that whole spectrum of, just trying to provide value through stock selection, and then I think you are going to see that's one of the areas of further growth in ETFs is going to be in that alternatives category. You're going to see a lot more of that.
Education is pretty important, isn't it, for investors to understand how they're going to utilize the tools that ETFs have to offer, because as you brought up before, passive index, that kind of thing, index tracker, whereas now there's a bit more in the way of more dynamic choices that are there.
I mean, that's the beauty of ETFs is you can go to our website every single day, see every holding, so there's no excuse to not know what's in any ETF. Now, the growth of ETFs, now there's 2,000 of them, means there's more to track. It gives more jobs for our advisors to go through and figure out what are the exposures they want. But it's just the information is there. I mean, my team, we have a research team trying to provide content on a daily basis to help people guide through what drives the markets, where we're trying to position and those kind of discussions. But those teams across all the ETF firms, there's a lot of education that all the ETF firms are providing, but the vehicle is literally the most transparent you can get. You can know your exposures every day, so it's the easiest to become educated on.
All right, excellent. If this discussion this evening were a meal, that was the appetizer. Okay? Now we get to the main portion here. Questions from all of you. Yes.
So, thank you all for your comments. I think it really depends. You keep talking about returns, but I think it really depends on what types of returns and who you manage money for. I, in particular, manage money for wealthy individuals, and it is not trying to be an index. It is goal-based investment. So their goal is, we discussed, is a 5% return. On your point, Jeremy, of risk-adjusted returns makes a big, a huge point. You can get 5% by doing it 100% in high yield, even potentially even short-term high yield, and get your 5%. But would that be risk? Would you get, would you get that all the time? And so we're not really trying to outperform a market. What we're really trying to do is get risk-adjusted returns and not have that kind of volatility.
And satisfy the client's needs.
Exactly. So I believe that those of us who are actually managing money appropriately, even if you're managing it for a pension fund, or managing it for education, or managing it for individuals, is you've got to get off of, trying to beat an index and really allocating. Now, having said that, it's really, really hard to allocate and get, beat any index. So the bogey is really, what are you trying to beat? You're trying to get 4, 5, 6%, what are you trying to get? So I take your, risk-adjusted returns, and I use Listen Tree because they do, in fact, honestly get risk-adjusted returns as opposed to just many of their funds that I've used, less volatile than a regular S&P. Now, maybe they didn't outperform last year.
Last year was a very good year.
I don't, some of it, depending on what it does, but it depends. My point on the credit sites is we do utilize your information. I think it's terrific. Is can you comment on whether it even makes sense to go? We talk about duration and credit research. Is whether it really makes sense to even go longer term on high yield, because really what you're getting an extra 1% or 2%, and the risk that you're taking on the duration risk, does it really, why would you even do it? And I've looked at historical numbers. I really use short-term high yield, and it's done really, really well. Can you even make a case for going longer term?
Sure. We've done that risk-adjusted return drill, and a lot of people play with those numbers in a lot of different ways to slice and dice it, but generally the best longer-term results have been low risk, high yield, and a medium grade strategy for credits like triple B and double B, they've generally posted up the best long-term risk-adjusted returns. Triple C, weak. High yield has done better than equities with a big, over longer term, but with a big asterisk around liquidity in those assets. Because as you saw in 2015, early 2016, bid on a high yield like a cop when you need one. That market can evaporate very quickly. But as you look out over rolling time horizons, 1, 2, 3, 4, 5 years and beyond, that we've looked back 20, 25 years, it stacks up pretty well. Because when you look at high yield, it's been...
I'm talking about short-term high yield, which I've used, versus going longer-term high yield. I understand the case for high yield, but short-term versus going out and extending it out.
And
You're making a point.
duration's in the eye of the beholder, because in the context of longer-term investing with a time horizon, 3, 5, 10 years, whichever it is. I mean, everyone has their own time horizons they like to roll into, including pension funds. The point is that it's a 4-year duration. That's the entire high yield market. So versus high grade market versus munis versus emerging market sovereign, it actually is a short duration asset class just because of the high coupons and shorter maturities. If you're talking about classic short high yield, very short callable paper, there you have issues also because you have extension risk, depending on the movement in rates and the movement in the credit market. So we think high yield stacks up very well, but you have to be very careful on how you structure it. And again, about half this market right now is higher quality high yield. I know it's high quality junk, it seems like an oxymoron, but very low default rates, sub 1% over the long term. So you can structure it, but then you don't want to be framed against a benchmark because you'll significantly out and underperform depending around the gyrations of the cycles. But generally, a lot of these companies have short yield to call paper until something goes wrong in the curve or something goes wrong in the credit markets, and all of a sudden you have extension risk on your hands because that's no longer going to be callable because it's not refinanceable in an unfriendly market. So it definitely fits, whether it be an allocation from rate-sensitive, long-duration, high-quality, or treasuries, or agencies, or high-grade corporates, or from equities. There's a risk-reward continuum in there. And if you look at, like, McKinsey just came out with a big report talking about 5 to 6% long-term real returns over the next 20 years in equities. That's real returns, 5 to 6%, and 1 to 2% in governments. And that's a classic bond stock mentality, when in fact there's this whole risk-reward continuum between there. High yield being one of those kind of hybrids between the two. So it's really more of an allocation from equities or an allocation from duration risk, and you got to pick your spots. But regardless, it's still short duration, and you're not going to have a high degree of sensitivity to a 100 basis point shift in the curve, in the context of if that's occurring for the right reasons, which is bullish fundamentals in the market. So you got to just be comfortable with the risk. I don't think people can think about 5 to 6% returns without taking a fair amount of risk in this market. It's the nature of the beast where the curve is, and you can do that very prudently in some types of what would be called high yield classic. You also people are moving the goalposts from high grade triple B to double B just because the sheer desperation of need for income. If you have an income bogey, if you have a person who wants to get X amount of dollars out of his pension, it's kind of a buy and hold strategy, but people don't like to admit very often high yield is buy and hold. It doesn't sound swarthy enough, but that's exactly what it is. It's very often a buy and hold coupon clipping drill. And the power of compounding is old-fashioned math, and it works. And you can see that in the numbers as you look back through the craziest 10 years you'd ever want to imagine in the high yield market, 15 years even. They outperform nominally and on a risk-adjusted basis, depending on how you frame it, what your comps are.
But a requirement with that is that there would be active management and there would be active research going on, rather than just, you buy a treasury and there's nothing else to think about. It's just the treasury, that maturity. It sounds like in the high yield world, you go long term, there are a number of issues that could come out, and if you're not, really, you have to stay on top of it. Is that a fair statement?
Yeah, you stay on top of it. It's just a lot less actives than equities. Actives in the eye of the beholder too. And I think a lot of high yield guys are in practice passive, in marketing campaign active. But if it's not in trouble, you just let it ride. Whereas it's different than an equity where you get into, okay, it's fully valued, time to rotate. You don't do a lot of sector rotation in high yield.
Okay. Yes.
I had a question for Doug. Thank all of you all for being here. Very interesting. Doug, back to, let's say, the Cisco example, but go down a lot of clicks to the average business. the small business optimism index about a week ago rose very, very high. The last couple of quarters on conference calls, a lot of CFOs, or if you talk to business people, especially business owners that I know, the last 5 years, they say, we don't know which way to go. We don't know what our insurance costs are going to be. We're afraid to spend money because we just don't see visibility. And quite frankly, they had an administration they felt they were at odds with. A lot of what I've been was hearing. So now you have a Treasury Secretary who's almost day and night, potentially the new secretary versus the old, and a cabinet that a lot of business people are pretty excited about when you hear their comments. Now, I know this doesn't happen in 6 months' time, but it seems to me that the atmosphere is a lot more enthusiastic when you talk to those type of people than it has been, and might give us maybe not a crazy wild earnings picture, but much better than people expect 18 months out, where they can start doing more things.
I don't share that optimism and confidence. And I'll remind you that though, as it relates to the large publicly held companies' executives, if you remember, there were very few that backed Trump. It was only after the fact that they have all come to Trump Tower and participated in the optimistic chorus. So my view is that there's a big difference between potential and kinetic, and that not only in the timing of reduced expensive regulatory burdens, cash repatriation, lower corporate effective tax rate, this is going to take quite a long time. And I do think that Trump faces in his own party a hardcore of Republicans that want revenue neutral decisions. So yeah, I'm a lot less optimistic. I also say that the squish, you know this from school, working for Jeremy, the squishiest economic number is confidence. It turns on a dime. In fact, there was an abrupt change in the this morning in the leading indicators of housing confidence. Builders' confidence came out, and it plunged very abruptly after having that kind of spike. Some have referenced this as a sugar high. Or in CNBC they call it hopium. So I think there's betwixt cup and lip, there's going to be a pretty wide range. So I'm less optimistic on the S&P earnings. I'm a lot less optimistic. You know, the tracking number for the first quarter of real GDP is still only about a little under 2%, 2.1% in the fourth quarter. You haven't seen it. You haven't seen it even adjusting for Amazon online digital sales. You haven't seen it in retail. You haven't seen it in a lot of places. You didn't. If you look at CAT's dealer statistics in the last month, it's worsening. So yes, there's a lot of optimism, but it's potential, not kinetic yet.
Could you see it more so, or a glint?
And then, by the way, the market believes it's happening, and I'm in a minority. But this is just my view.
And it may be a hit, but I think maybe could you make a case for the Russell 2000 versus the OEX companies? Just take the big 100 out, okay? Because of this, so many business people I've talked to have Obamacare has just weighed them down from hiring, a lot of other things.
Yeah, I do. And also, you get back to what I said about the effective tax rate. Apple's effective tax rate's 8%, Cisco's 9%, Microsoft's 10%. So you take out the big company, so reduction in the statutory rate is not going to have a material impact on them. In fact, it could have an adverse impact on them because you're going to reduce a lot of the deductions that led to low effective tax rates, under 10%. So I think in the main you're in the right direction. But the Russell has already outperformed dramatically. So, I just think that getting back to this confidence number, It's a flashy number, 110 consumer confidence, but it really is a squishy economic number.
From the economic side, I'd wanted to add something in there. I mean, when you think about what's been really disappointing is we know we have sort of lower the labor force is declining, demographics. We have sort of declining labor force participation. So the economy is sort of how many people we have working and how productive are those people. And productivity has been the most disappointing part of this recovery. So when you think about, and you started off the conversation, Doug, by saying you got macro factors, fiscal factors. Really, it's productivity that we need to figure out what are the challenges around this productivity number, because the monetary policy, they're already saying they can't do anything there. I mean, they're at their limits there. Fiscal, I wouldn't characterize our U.S. economy as a demand problem. So fiscal is what Europe needs. Europe needs a lot of fiscal policies. They have real demand problems. We have a productivity problem, and so the question is really what are these measures that are going to help increase productivity? And I think the technology question you brought up earlier is there is going to be a lot more automation, and I think one of the big struggles we as an economy we're going to have to face is what happens as more and more jobs are replaced. You could have much higher unemployment than we were used to historically.
This is the irony that you could have. Even if you get the fiscal incentives to expand CapEx, that CapEx might, as Jeremy implies, result in disequilibrium in the labor force, i.e. less jobs. I mean, it's amazing what's going on in retail. This is really scary. My first surprise in my surprise list this year, and I thought it would happen in January because vendor invoices were due on January 10th for Sears. I think Sears is going to go bankrupt. I think it's going to be a very big story. They employ 270,000 people in the country. J.C. Penney is going to close 300 stores. Sears will downsize in bankruptcy. The mall business is cratering, and it's getting worse. I mean, the Target numbers were so bad that no one, I don't know if you have kids or grandchildren or spouses, no one goes to the mall anymore. I mean, I have an Amazon shipment every single day. I ordered Barry Levinson's The Diner movie today.
We probably get more than one every single day.
I get much more than one.
Well,
I usually buy my book so I get the sales up so I can see, like I'm number 6 on Amazon.
Well, another thing tied in with that is fintech and banks. I mean, if you go to a bank, it's certainly up in New York. If I go to a Chase Bank, it's like a ghost.
Oh yeah,
Ghost town in there.
We're so overbanked and over ATM'd.
Physical properties.
Yeah.
Yeah. Okay.
So, and this is the other problem. Trump was elected because, in large measure, he provided a platform for those that were disfavored. And there was no trickle down. It was all trickle up from monetary policy. And I'm very concerned that we're going to see a lot. We get repatriation, and you'll see the Cisco effect. There'll be no new jobs. There'll be no physical plant expansion. And there'll be no trickle down. It'll be all trickle up. Salaries will be increased. Share price, those people with large balance sheets of homes and stocks will prosper and benefit. But the screwflation of the middle class will continue. And we're not addressing the most serious issues because we're kind of like in ADD society. We have a mismatch of skill set. When I was a kid, I was a philosophy major. That would really work out well for the job market. And, we don't have enough nurses. We don't have enough mathematicians, programmers, teachers. And the politicians don't have the attention span. The electorate doesn't have the attention span.
So on this
and digitization is killing us, and that followed globalization, so we're in trouble.
If you want to say something real quick, okay.
Quickly on the nurses. So I got to interview Pat Harker, who's the former dean of Wharton and now the Philly Fed president, about 2 weeks ago, and he said in the 3rd district, what he manages, a hospital just had to do a 9% wage hike to all the nurses and the second year in a row they had to have a big wage hike because there is no nurses. So he's starting to see those wage pressures coming in, and so he may be more hawkish than others are expecting.
Okay, very good. Question back there. Gentleman had his hand up.
I got a question on inequality, tax rates, automation, and confidence. I think inequality, you say with Trump, will have a divergence of income inequality. We've had a historic divergence with Obama's policy, so I would argue those low interest rate policies were a disaster in terms of the income distribution and how it's falling out.
I would say that the income and wealth inequalities has nothing to do at all with either Democrat or Republican policy. There were some major trends, starting with globalization, moving towards digitization, where technological obsolescence of jobs we discussed. Thirdly, there was a skills mismatch between graduates and what was really required. And finally, this happens to be a Republican issue that I agree with, there was this costly, expensive regulatory burden, which after the Great Recession in 2008, 2009, led large corporations who had a small increase in their top-line sales growth. It forced them to utilize part-time labor as a long-term solution to their labor costs because they didn't have to worry about pensions and health care and all those other things. These trends would have occurred no matter who was in office, in my view.
On automation, I'm hearing that it's a headwind, but it's obviously a key driver of productivity, which we certainly could use more of in this economy. McKinsey put out a study at Davos just in recent days, where they studied a very large percentage of the current jobs in the U.S. economy. And they concluded within 10 years, automation will replace, I think it was like 5% of the jobs. It was only a fraction for most jobs, and in many cases, it functions to make people more productive. So I think that automation here is sort of overblown, at least at this point in time. I'll let you comment on that. And also want to mention tax rates. I'm curious, your tax rate number is very convincing in terms of 27%. I'm wondering if you took out money-losing companies, if that looks a lot better.
You're probably right. Can I just read you very quickly something I wrote about Davos this morning that was in Barron's Online? First of all, this is a quote from The Guardian. Naomi Klein wrote an article yesterday. We have witnessed the rise of the Davos class, a hyper-connected network of banking and tech billionaires, elected leaders who are awfully cozy with those interests, and Hollywood celebrities who make the whole thing seem unbearably glamorous. I wrote, the World Economic Forum in Davos has outlived its usefulness. In a world in which the 8 richest individuals hold 50% of the global wealth, Davos has become a tone-deaf setting in which cocksure elites go to agree with each other. The numerous predictions made annually at Davos have been consistently way off mark. In a world of populism and nationalism, Davos consists of a bunch of transnationalists who view borders as obstacles and who view national loyalty as an anathema. Most importantly, they have failed to address the economic challenges of the average Joe. My recommendations: move Davos to a resuscitated Grossinger's Hotel in the Catskills next year. More gefilte fish, less caviar. More chicken soup, less French onion soup. More flanken, less chateaubriand. More shuffleboard, less skiing. More Manischewitz, less Moet. More red buttons, less Bono. More Milton Berle, less Nouriel Roubini. More Jackie Mason, less Joe Kernan.
Very good. Very good. Well done, yes. Okay. Gentleman over here, question.
So, can you talk a little bit briefly about the, specifically with the 10-year yields, how much they moved recently, and what is your forecast for where the 10-year yields may be? And Doug, for you, for what does that hold for the PE multiples? At one time, they were correlated with 10-year yields, and now, since about 2014, they've become inversely correlated with the divergence going.
I always thought stock valuations were hostage to rising rates. That's what I learned. But apparently I'm wrong because, your discounted dividend model, it deteriorates with rising rates. I said in the summer, on July 10th that we faced a generational low in yields. And I believe that. 133 on the 10-year at the time. And I thought that we'd move up rather abruptly. I personally think that we're going to be range bound. I think that's what Glenn thinks for a while, because I also think, besides the point that he made, I think there's tremendous demand for yield from pension plans, from large cash flows from pension plans and other, eleemosynary institutions, foundations seeking yield, which will cap rates. And again, I think I'm in the slower growth camp. So,
as low as our rates are.
And really was specifically to you that how much, and I agree with Doug that we're going to be range bound, especially if you look at comparable spreads with the German bonds. We had a spike in the 10-year yield after the election. We also had a spike in the 10-year bond spread with the U.S. 10-year Treasury, and now that seems to be narrowing back down. So with the bonds, for example, not being able to move much more past 30, 35, or 40 basis points, how much more room is there, for example, in this year, for the 10-year to go out to 3 or beyond, as people are talking about?
Well, they can get out to 3, and I think a lot of people thinking it can go to 3.25. We would say the outer limits would be 3.5, but where we are right now, just looking at the 5-year, we're the highest yielding 5-year in the world among major developed nations. If you look at all the European countries and some of the usual trading partners, the only thing wider than us in the 5 years is Portugal, and they were in receivership a few years ago. So I mean, we are the high-yielding, deepest, most liquid market. So if you believe if people are going to be bullish in the dollar, you could even see capital flows coming in as well. So we don't think it gets too far out of whack in the 10-year or even the 30-year. It's the front end and how fast as it comes up. But then we don't think that will be unmanageable either. We don't see the curve being people lost a lot of money in the long end, after the election, but we don't really see that from here being a major problem for the marketplace. It's really just going to be about, I think we're forgetting about the tax bill, some of the things they're putting out there about deductibility of interest and other things.
You don't
There's
know
a lot of stuff.
You don't know how to compute everything. I know I had a handout 3 or 4 years ago when I was here on this subject, and if you look at the last 6 decades, basically, the 10-year yield tracks nominal GDP, real GDP plus inflation. It's really like 95% of it. So what does that mean today? The 10-year was up 11 bips to, say, 243. That's saying that nominal GDP, and let's discount it for secular stagnation, all the headwinds we know about, it's implied, and the core CPI was, for the first time, 2% this morning, it was announced. So it's basically implying, 1% real growth in the economy, which is, there's a lot of weird stuff going on.
Because as you said,
And a large portion is that suppression of rates vis-a-vis the EU economy, because everyone's doing, this massive arbitrage. This is what scares me. The banking industry in Europe is in such bad shape, and their balance sheets are grossly leveraged, never reduce their leverage. And what does it consist of? Bad corporate loans and sovereign debt with negative yields. It's scary. It's real scary.
because if the spreads keep widening beyond one, more the dollar becomes stronger, and you have $3 some odd trillion of emerging market, dollar-denominated debt, where the emerging market economies are getting trashed, their currencies are getting trashed. What kind of risk do you see playing out specifically with dollar-denominated emerging market debt?
Well, you saw they get beat up initially, but that's actually held in pretty well. I think the main of the benchmarks out there and the USD indices for emerging markets, the emerging market sovereigns, which is mostly BBB and below, that's a long duration benchmark, and that thing is going to get whipsawed around with the curve, but we don't see the curve doing that much damage. I think there's a very deep base of demand in this country for higher risk credit right now, and I think that's going to continue to be the case. If you believe some of what, there's one school of thought, you might have seen this out there in the financial media lately, is if they do go with the House blueprint and eliminate deductibility of interest, you're going to start to see the high-grade market, which has soared, it's tripled from $2 trillion to $6 trillion this cycle, start to taper off. And there's going to be excess demand for these debt instruments because there is a strong secular trend towards needing income, needing credit assets. There's great demand in the pension space and the insurance space. We're talking about easing the capital charges in insurance, where there's going to be higher demand for lower grade credit quality. You're going to see a very strong bid for anything fixed income, I think, that has some risk. And has
So
some
that
yield.
helps explain the lack of relationship between the 10-year and nominal GDP in part.
Yeah, that and there's obviously been distortions around Europe and our own monetary policies. There's been never a market like this. I mean, when I broke into the market, the first high yield cycle I was in, just as that one was cracking, 90-day T-bills were 8%. I mean, that would give you a fit now.
The most interesting thing is that the percentage of Treasury short by speculators are at an all-time high this week, and the volume of VIX contract that is short is at an all-time high.
Well, there's extraordinary demand in the banking sector also. I mean,
Oh,
there's
yeah, I
just
forgot about that.
a lot of technical issues around that keep bid very strong, including liquidity requirements and so on. We don't think those are going to change. No matter what they do in regulatory rollback, it's still going to be all about liquidity. It's still going to be all about quality balance sheets for the banks. So I just don't worry about the curve getting completely out of whack. People will want to run their hyperinflation scenarios, and it just doesn't resonate when you look at it in the broader context of global sovereign curves.
In the equity markets, one can make a trade that we are in a rotational investment environment. We had energy, the worst sector, 2015, the best sector in 2016. Healthcare, the best sector in 2015, now is the worst performing sector last year. So it's first to worst, worst to first. Same thing with international markets like Brazil, being the worst country, now being the best performing country. Can you say that perhaps the high yield is the same kind of phenomenon, the worst to first, a rotational environment?
Okay, I'd like to bring in other people too for questions, so if you can answer that very
Sure, yeah.
quickly.
I mean, it's, you got to define your time horizons more than the bonus year. That's what Wall Street does. And you're looking at 3 to 5 years. If you want to get into an asset class and rotate into it, you got to have a time horizon that includes some potential downside. But the worst to first thing, that's a very common feature in high yield.
Okay, very good. Before we run out of time,
Yeah, every now and then it pays to look out the window. And in '06 and '07, if you looked out the window, you saw building just going through the roof. And I don't know if I'm getting the wrong impression in South Florida, but there's just a frightening number of buildings going up. And I don't know whether this is happening throughout the country, but it looks like we're getting set up for another real estate boom.
well, okay, if there's someone wants to, let me just echo what you just said. If you come to New York, you will see in Williamsburg and Brooklyn and in Long Island City, which is Queens, unbelievable amount of building that's going on, especially right around that Queensboro Bridge. I don't know how the infrastructure is going to hold it. They're putting so many buildings up, all right around the by that intersection in that area, and they're both commercial as well as residential. Anybody have any thoughts on?
Well, I actually started as a housing analyst at Kidder Peabody, and over history, cyclical housing peaks always occur on the coasts, start on the coasts, specifically South Florida and Orange County, California. That's the way it works. That's where all the speculation occurs. And I coined a term, the South Sea bubble. I coined a term, the South Beach housing bubble is now occurring. There is over 4 years of housing supply in South Beach right now for sale. Unprecedented, never been seen before. If you have a unit, everyone's now trying to rent it. The rental market is terrible. And it's just starting, and what it does is it started to filter up north towards Fort Lauderdale, Palm Beach, where I live. And it happens every cycle the same way, and it's happening now. On the West Coast, Silicon Valley peaked about 9 months ago at ridiculous prices. Orange County, turnover activity and home prices are now depreciating. So it's starting, but it always, as they say, history doesn't repeat itself, but it rhymes.
I think there's a very multi-tiered, complicated story going on in housing right now. The luxury markets, and I do a lot of work on Realogy and some different names, and in New York, for example, over $2.5 million price tag is 19 months of inventory. But if you start peeling back the MSAs around the country and look at different price tiers, there's a dramatic shortage of housing relative to natural demand.
Middle market.
Middle and low. Yeah. For entry level, not as much. The move-up market is very firm, but first-time buyers and entry levels is smoking hot, and the problem is they don't have enough labor. The housing starts are about 15% to 20% below long-term averages, and given the demographic needs and household formation should be a lot higher. So the result is they can't build them fast enough in those tiers. Prices are going up, affordability is getting squeezed, and now rates are going up. So it's a real good old-fashioned housing affordability crisis in the low end, but the demand is not going to go away anytime soon.
The other problem is Glenn talked about corporations refinancing, so they're relatively well positioned, so you have low defaults. So many people refinanced their mortgages that if we have a continued mortgage rate surge, the mover up, which is very important, is the second most important behind first-time buyers, are not going to be able to afford to move up because their mortgage rate will be going from 3 1/8 to 4 7/8. And that's really important, to people with a certain, with a middle income.
It feeds itself because then they don't sell. So the whole dynamic breaks down because there's no existing home inventory for sale. So the builders get in there, they can't build fast enough, but prices keep going up. Meanwhile, their margins are going down because it's a subcontractor's market. It's a seller's market right now. And that's where you get into this whole issue on Mexican labor and so on. It's a different topic.
All right, we have time for 2 more questions. All right, there's 3 hands up. So this gentleman here, then Phil in the back there.
Which sectors do you see performing well in 2017, like biotech, oil and gas, gold, technology?
Any thoughts? I'll tell you one sector that I would go into, and that would be cybersecurity. And I'll give you the reasons why in a little bit. Your thoughts? And water on a long-term basis. It's a thematic play. You can do that through ETFs.
The leveraged E&P sector is coming out of some severe ugliness, and you might have seen some things on the screen today. They're talking about not only they're raising capex, it might come closer to justifying their valuations, but on top of that, they're so they're getting price relief and volume relief, and they're starting to get more people taking a different view of the underlying values of the companies. So we're not back to the future by any stretch, not at these prices, but E&P is still a sector that's getting back into favor. Not as much upstream services and equipment as just pure E&P plays. Mm-hmm. So that's kind of been an obvious one for a while, but what's interesting is they are now in a position where they can actually refinance in the high yield market. God help us, it's almost a par market again.
Phil?
Yes, I was going to ask, we live in an age of great change, and everyone tells us it's only going to get worse. We've seen almost tectonic shifts during the last year. And what the likely effects of the Trump administration and some of our leading economic political institutions here, I think, first, the Federal Reserve, of course, the Supreme Court's. Are we going to see them get Trump-sized?
Anyone?
Well, on the, I'm not sure how many of you have been watching these border adjustment issues and these import tax concepts floating around.
Every day it changes.
It's horrifying. As somebody who spent most of his career looking at manufacturing companies and autos and machinery and low-end companies, it's just look at some of the charts we threw in there. We just threw in this, just break out the list of imports and you look down at it's just from the census disclosure, and you realize the potential carnage that could be done to some global supplier chains that companies have spent years working on building. It's not like it's a frictionless wheel. If you start hitting those global supplier chains, you're undoing many years of hard work. And regardless of how you feel about cross-border trade, Mexico, China, the fact that they'll play roulette with that kind of an issue without digging in a little bit more and presenting a little more granularity to the public is kind of disturbing. So that's the scariest thing I've seen, I think. And especially if you read the economists' views of it, it's just grounded in all of these theoretical economic assumptions around what the dollar will do and how it will offset. And you wheel out that old line about what does an economist do on a desert island if he has only canned food? He assumes a can opener. That's an oldie but a goodie, and I think it applies in the case of these border adjustment taxes.
Okay, and we have time for one more question. Jim.
That was pretty much my question on the whole trade war issue. So I think that's the huge threat.
Yeah,
Okay,
the lack of refinement in the analysis you see, you expect that out of Washington, but you really haven't seen, you're starting to see some equity guys do it. Like if you slap a 20% essentially you can call it a border adjustment if you want, but it's still a tariff and drag. And you look at that, and the retailers are starting to flip out about it. Obviously, they're first because everything they buy is offshore. But the potential impact on a lot of the offshore assets of multinationals, and globalization was a thing, right? Okay, if we're against it now, that's good to know, but their entire cost structure and their global investment profile has been predicated on it being something that is sustainable. So there's so much money, so many tens of billions sunk in to China by different industries. It's kind of like the supplier chain we helped create with China, yet we blame China, and the same in Mexico. And the difference in Mexico, a lot of what comes north has a very high U.S. content in it already. So trying to untangle that Gordian knot is painful. So if we do go down that path, there's going to be a lot of pad scratching to do to figure out who's getting damaged and who's winning.
I would answer Phil's question the following, that the only market, political, and economic certainty is the lack of certainty in 2017.
Is there any intelligence in Trump Tower? And has anyone ever heard of or read Emmanuel Velikovsky's Cataclysmic Evolution, which was brought to my attention in my school of higher learning back in 1962-63 in a sociology class in all days?
My answers are no and no.
It's on the list now.
After World War II, in Pax Americana, was to have managed incremental change. It's all about system persistence.
Remember Queens?
History and evolution, biological and cultural and social.
I know you remember Queen's Bohemian Rhapsody, right?
Pardon?
Is this real life or is this fantasy? That's the way I feel about things.
Why don't we go with one last question? Gentleman back there, you had your hand up?
Yeah, so my question is around the Fed. Like, all of a sudden, nobody talks about it anymore, right? It's about whether they're going to raise 25 basis points or raise 3 times or raise 1 time. But it seemed like over the entire last cycle, not just the Fed, but the ECB, the BOJ, seemed to be, there was a policy response function, whether it was, the second financial conditions tightened to a certain extent, they came in with increasingly larger and more powerful policy responses. Now we're switching over to fiscal policy. They're already talking, Bullard, Rosengren, they all started saying, okay, we have to start, if we're going to raise 100 basis points, so we also have to start taking away from the balance sheet. So it seems like the central banks in earnest are, in speeches and in general, saying we're stepping away from the fray and we're letting either the real economy or fiscal policy take over this as much as possible. Do you think that's going to affect valuation, credit spreads in the longer term, or do you think it never really affected them in the first place?
To your last point, not as much about tightening, but the balance sheet unwind, if that they start doing that anytime soon, well, that's your curve shift and curve steepening risk, and that's where all bets are off. It just seems, I wouldn't think so this year. It seems a little early in the game. I mean, they still have, last year they said they're going to get 4 tightenings, and we didn't get one until December. So if we get 3, that would be, I mean, the market's handicapping less than that, but no one's handicapping right now that they're going to start to stop reinvesting and start to unload securities. That happens, things are going to get downright exciting.
I want to leave you with one surprise very quickly, one of my second surprise for 2017. And we've already seen this with Peter Thiel. Is that how you pronounce his name? Thiel?
Yeah.
Peter Thiel, the Facebook board member and I think PayPal founder, saying that he's considering running for governor of the state of California. Right. Mark Zuckerberg, in his SEC filings, talked about running for political office. And this afternoon when I left, Kevin Leary from Shark Tank is planning to run against Trudeau in Canada. So I think that Trump has basically, his victory is establishing a very big precedent in which there's going to be this broad movement of celebrities, you're going to laugh, athletes, actors, businessmen, people without any political or military experience running for office. People like Peyton Manning, people like Oprah, people like Ashton Kutcher. people like Mark Zuckerberg. And I'm going to predict that we come back, and I promise I'll be here in 3 years, that the nominee, I'm going to predict the nominee for the Democratic Party, someone who has had no political experience, and if you give me sufficient odds, Phil, I'd be happy to make a wager on this, will be Howard Schultz from Starbucks. I believe that he's setting the stage by moving off the chairmanship of Starbucks. He will set the stage for a run for the presidency. And
Okay. Good. Well, with that, let's go to closing comment, the last segment. Ask each of our panelists to give us one thought that they would like to leave with us. It could be an actionable idea. It could be something we discussed. It could be something completely different. Jeremy, why don't you go first?
So I didn't really get to talk about where I would position, the different parts of the market. So I think if I'm thinking about where I'm personally allocating towards where I think benefits from some of these policies, I think the U.S. has had an extremely strong run. I think international has underperformed for the last 10 years. I think where you think about forward-looking returns, just a valuation perspective, the earnings yields, dividend yields, I tend to favor international. I'd say if there's a country that benefits from rising rates, what is the one that's the inverse bond trade? Japan. You saw at the beginning of last year, utilities were up 23%. Japan was down 23%. Post rates started moving up, Japan way outperformed. So I think that is one, part, sort of the country I perhaps most bullish on over the coming. It's not just a rates trade. I mean, that's part of it, but I think over the 5 years, I think there's a lot of really good things happening from the corporate governance side, increased shareholder returns, and I do think we're in a longer cycle for the dollar. So, if you were super bearish of the dollar, you thought the yen was going to go up, I'd say be out of Japan. But if you think you could do a currency hedge, it's a cheap market, that's the one I'd probably be in.
Excellent. Glenn, your closing comment, please.
We always try to have conviction and granularity in how we look at different asset classes and how they perform, but take another look at that total return quilt over the last couple of decades, and there is a reason why people diversify, because a lot of curveballs get thrown, and there's some guys throwing some big curveballs this year potentially. And we would spread your risk around higher income products and take some risk in credit, because the credit markets are in very good shape. However, again, I wouldn't rule out the fact that duration could be quite stable. We're into run scared from rate risk, but we don't think that's the way to go. I think it's credit risk this year still.
Okay, thank you. And Doug, your closing comment.
I just repeat what I said before. Beware of investment narratives that change as prices rise. Be wary of catchy phrases like animal spirits, because as I said before, there's a reason why they call it animal spirits and not human spirits. Animals are a lot dumber than humans.
Okay.
Synergies, that was 60s, you're dating yourself. The conglomerates in the late 60s, Litton Industries, Teledyne.
Yeah.
Perfect film.
Right. Okay, so with that, I just have a very brief closing comment myself, and an observation that I think you might find of interest. I had mentioned earlier, well, two areas that we didn't talk a lot about is cyber and geopolitics. We touched on political, but not in this one particular way that I want to mention to you. In the cyber area, I really implore all of you to watch that docudrama. It's called 0 Days. It involves General Michael Hayden has been interviewed on it, Richard Clark, it goes on. And if you really want to understand Russian hacking, if you really want to understand where things are at from a cyber point of view, if you really want to understand the probabilities of a physical world, a real world impact from cyber in the form of an attack that hits, for example, the power grid, all right, then you want to watch this thing. It's well worth it. It's about 90 minutes, and it's very, very powerful. And it'll help to frame everything that's going on now. And with that, I will give you also one phrase, 2 words, to kind of think about. Maybe this will pique your interest to go watch it. And that is Nitro Zeus. And if you don't know what Nitro Zeus is, then watch the movie, because you'll find out about something that will blow you away. It's real. This is not a fantasy. This is the United States' ability to shut down the entire country of Iran. It already exists. Now, secondly with it, okay, second point to bring up,
Can they do that to Brooklyn?
they can do it right now. It's
To
there.
Brooklyn?
And then, the second item here is geopolitical. I raised this up in conversations with some friends over a month ago, and I'm surprised you don't hear a lot about it, but Richard Painter, I believe his name is, Painter, that he was the chief ethics lawyer under George W. Bush, raised this issue twice. Once in writing, I believe it was an op-ed in the New York Times, and another time when he was interviewed on Stephanopoulos, okay? And that's the issue of the following. Whose name is on properties in many parts of the world? A number of those parts are areas where there might be terrorist activity.
Putin.
Putin, right. Trump. Isn't it easy
Say that
for,
again?
Isn't it easy for terrorists to bomb for maximum effect Trump facilities? Not Trump Tower, can't get there, but Trump in Mumbai, Trump in Indonesia. Wonder what the geopolitical dynamics of that would be. Something to think about. One observation. I've been doing this for 19 years. Tonight, maybe it's because the way the flow of this conversation went, but I don't think so. Tonight, I noticed there was a pattern. Remember, I mentioned those your questions. That there was definitely a pattern, and I've never seen this before. Almost every single question was prefaced by opinions to a fairly significant degree. And it sort of says something, I think, about the environment that we're in, is that all of you, the number of you, the vast majority of you that asked questions didn't just ask a straight-up question. You went into a discussion and an opinion. And I think that's kind of interesting, because it's almost like the social media thing playing out now in real time in meetings and stuff like that. It's just an interesting dynamic. I've never seen it. 19 years, I've never seen that before. Never.
Can I ask you a question to end?
Sure.
So, in light of these uncertainties, in light of your implied concern, your discussion of cyber terrorism, for example, which many of us agree with as to the risk, why not gold? For the first time I bought gold.
Don't disagree. Yeah.
For the first time I bought gold, not only was it cheap relative to other assets, but it has a good
Sure.
chart.
Hedge against uncertainty,
That's all I have.
hedge against instability. Yeah, without a doubt.
You know what Howard Marks said? He says, gold is a lot like religion. Either you believe in God or gold, or you don't.
Very good. And then the last one, my closing comment is just a bunch of thank yous. Thank you to the board. I love doing this. We've been doing this for so many years. It's just a great deal of fun. And we do the one in the fall also on alternative investments. Absolutely terrific. Partner in crime, Phil, always a thank you to him. Thank you to all of you for coming here this evening. Really greatly appreciate it. This is a terrific turnout. I hope you found this to be really a productive, stimulating discussion that took place tonight. And then I ask all of you to please join me in thanking our panel for an excellent.
Good meeting you.